Gold has gained over 100% in 24 months. U.S. home prices, in real terms, have gone nowhere. If you own a home and some savings, that gap is not a trivia stat, it is happening directly to your net worth right now. So let's go mechanism level on why, and what it actually means for how you position yourself. Here is the core fact most financial commentary skips. The two biggest assets most ordinary households actually hold are their home and whatever savings they have outside it. And those two assets respond to the same macro forces in almost exactly opposite ways. Inflation, interest rates, credit conditions, liquidity crises, they all hit gold and real estate through completely different mechanisms. Most people comparing gold and real estate are looking at the wrong numbers entirely, so here is exactly what the data says right now. Gold spot price, $4,540 an ounce. 2 years ago that number was closer to $2,000. That is a gain of more than 100% in roughly 24 months, and the mechanism behind it is not what most people think. Meanwhile, the U.S. national median home price has barely moved in real terms over the same period. The S&P CoreLogic Case-Shiller index has shown price gains that look impressive in nominal dollars, but once you strip out inflation using the CPI index, now sitting at 332.813, those gains shrink dramatically. Real estate has, in many markets, lost purchasing power in real terms while gold has roughly doubled it. That is not a small difference. That is a structural divergence, and it has been building for years. Now let's talk about how each asset is actually valued, because this is where the comparison gets fascinating. Gold has no cash flow. It pays no dividend, no rent, no interest. Its price is essentially a consensus view on how trustworthy government money is and how much counterparty risk exists in the financial system. When the federal funds rate sits at 3.63% and real GDP growth is only 1.5%, that is a low growth, still elevated rate environment where the opportunity cost of holding gold is real but the macro backdrop keeps buyers engaged. Real estate, by contrast, is valued on cash flow, on rental yield, on cap rates, meaning the ratio of income to purchase price. When the Fed funds rate was near zero, cap rates collapsed and prices surged. Now that rates are at 3.63%, financing costs are elevated and cap rates have been forced higher in many markets, pushing prices down or flat in real terms. Gold has no borrowing cost dragging on it. Real estate lives and dies by the credit cycle. That is mechanism difference number 1. Mechanism number 2, supply dynamics. Gold above ground, all of it ever mined in human history, fits inside roughly 3.5 Olympic swimming pools. Annual mine supply adds only about 1% to that stockpile per year, a rate so stable it barely moves the needle. Real estate supply is theoretically unlimited because you can always build more, but it is constrained by zoning, land, labor, and materials. In practice, U.S. housing starts have been chronically low since the 2008 financial crisis, running well below the historic average for nearly 15 years. That supply shortage has underpinned prices. But here is the key difference: when credit tightens, real estate supply and demand both contract, and the market can seize up entirely. Gold always has a buyer. Central banks, sovereign funds, retail investors across 195 countries. The gold market never seizes up. Mechanism number 3, who actually holds each asset and why? Central banks now hold over 36,000 tons of gold globally, and they have been net buyers for 15 consecutive years. In 2024 alone, central bank gold purchases exceeded 1,000 tons for the third year in a row. These are not retail investors chasing a trend. These are sovereign entities making multi-decade strategic decisions about reserve diversification away from the US dollar. Real estate, by contrast, is increasingly held by institutions too, but for entirely different reasons. Institutional landlords, REITs, real estate investment trusts, and private equity firms hold real estate because it generates income and offers leverage. When credit gets expensive, those same institutions sell. Central banks do not sell gold because rates went up a point. The holding motivation is completely different, and that changes how each asset behaves in a crisis. And speaking of crises, here is mechanism number 4, how each asset responds to the same macro shock. Take a sharp liquidity crisis, like March 2020. In the first wave of that sell-off, gold dropped about 12% in 2 weeks as leveraged traders sold liquid assets to cover losses elsewhere. Real estate did not drop in those 2 weeks because real estate cannot be sold in 2 weeks. But 18 months later, gold had recovered fully and set new all-time highs, while real estate in certain sectors, especially commercial and retail, had suffered structural demand destruction that is still playing out today. Liquidity cuts both ways. Gold's liquidity means you can sell it fast in a crisis, which is painful short-term but healthy long-term. Real estate's illiquidity means the pain is delayed, not avoided. Now, a lot of you have been asking in the comments where gold goes from here. With gold at $4,540, does it hit $5,000 by end of 2026? And honestly, that is the wrong question to start with. What matters is the structural setup. The Fed funds rate at 3.63% with GDP growth at only 1.5% suggests the economy is running well below its potential. That is a setup where rate cuts become more likely, not less. Every 100 basis points, that is 1% of Fed rate cuts, has historically pushed gold meaningfully higher because it reduces the opportunity cost of holding it. I am not going to tell you gold hits $5,000. Price prediction is not the game here. But the structural inputs that drive gold upward, dollar credibility, real yields, central bank demand, all three of those are pointing in the same direction right now. Mechanism 5, Inflation sensitivity. Gold's relationship with inflation is widely misunderstood. Gold is not primarily an inflation hedge. It is a currency debasement hedge, which is a subtly but critically different thing. Inflation is rising prices. Currency debasement is the erosion of confidence in the monetary system itself. You can have one without the other. The CPI index at 332.813 tells you prices are elevated, but gold at $4,540 tells you something deeper, that the market is pricing in structural doubt about whether the dollar maintains its reserve status over the next 10 to 20 years. Real estate, meanwhile, does function as an inflation hedge in the traditional sense, because the replacement cost of structures rises with inflation and rents tend to follow nominal price levels over time. But it is a slow, illiquid, maintenance-heavy hedge. Gold is a clean, portable, zero-counterparty hedge. Different tools, different jobs. Mechanism 6, Leverage and hidden risk. The vast majority of real estate is purchased with debt. A typical 20% down payment means you are carrying 80% leverage from day one. That leverage amplifies gains on the way up and amplifies losses on the way down. In 2008, millions of Americans discovered what 80% leverage means when prices fall 30%. Gold is almost never purchased with leverage by retail investors. You buy an ounce, you own an ounce. No margin call. No bank can foreclose on your gold. That asymmetry in risk profile is enormous, and it is almost never discussed in mainstream financial media. Here is a cost that almost nobody factors in when comparing these two assets. Real estate carries property taxes, insurance, maintenance, management fees if you rent it out, and transaction costs of 5% to 10% on the way in and out. Physical gold has storage costs and capital gains tax when you sell, but zero ongoing carrying costs beyond that. Run the numbers over 20 years and real estate's friction costs can quietly erase years of gains. Gold's cost structure as a liquid store of wealth is dramatically lower than most people realize. Mechanism 8, Global portability. Real estate is immovable by definition. It is subject to the laws, taxes, and political decisions of wherever it sits. A government can zone it, tax it, seize it, or let it flood without compensation. Gold can be moved across borders. It is recognized in every market on Earth. In a genuine geopolitical or currency crisis, that portability is not a small advantage. It is everything. So here is the honest verdict. Real estate remains a powerful long-term wealth builder for people who can manage the leverage, the illiquidity, and the ongoing operational complexity. If you have a long time horizon and access to cheap credit, real estate with leverage has historically compounded wealth effectively, but gold is not competing with real estate on those terms. Gold is the asset you hold when you are worried the system the other assets depend on is itself under stress. When central banks are buying thousands of tons per year, when real GDP is only 1.5%, when the dollar's share of global reserves keeps shrinking, gold is not a speculation. It is the asset that understands the problem before most people are willing to admit there is one. The question is not gold or real estate. The question is, which role is each one playing in your portfolio, and which side of that structural shift do you want to be on when the mainstream finally catches up? If you want to keep going deeper on gold, macro, and how real money actually works, subscribe to this channel because every week we go mechanism level on the assets and trends that mainstream financial media either misses or explains badly. You will get real data, real comparisons, and honest analysis without the hype, and without someone trying to sell you something. And look, I want to be clear about something important. I am just someone genuinely obsessed with this stuff, reading everything I can find and sharing what makes sense to me. I am not a financial advisor, this is not personalized advice, and you should absolutely do your own research before making any decision. Think of this as one informed perspective from someone who finds this stuff fascinating, not a recommendation. If something here sparked a question or changed how you see it, drop it in the comments below because that conversation is exactly why this channel exists.